Julian Emmanuel is here with us now. He is U.S. equity and derivatives strategist for UBS. Julian, thanks very much for being here.
Thanks for having me.
All right, give us your prognosis for what happens to stocks the rest of this year without an increase in interest rates.
Without an increase in interest rates, well, if there is no increase in interest rates, what we get is an economy that's perhaps a little bit slower than everyone expects, but yet you still have cheap oil and, as you say, low interest rates. And in that kind of environment, if people are prepared to look through earnings into 2016, as has been the case for most of this year, we think multiples can expand and you can still move higher.
Okay, your year-end target on the S&P 500 is 2225. That's pretty much in the median, dead in the middle of a Bloomberg survey. And yet your call is for the Fed to, in fact, raise rates this year. How do we get a 7% bump in the S&P 500 when there's no earnings growth?
Again, the backdrop of where the Fed is coming from, where oil is still cheap and interest rates are still low on an absolute basis, and which is why I think you've seen so much volatility in the fixed income markets not translate into the equity markets, because you're from that 2% level, the 10-year, from essentially zero, according to the Fed. You still have room for multiple expansion in an environment like that.
Explain the connection between recessions and stock market movement.
So essentially, our work shows that over the course of, say, 50 years or more, that basically you don't have bull markets finish without either a recession or the Fed catalyzing a recession by raising interest rates.
I mean, only recessions kill the bull.
That's correct. That's correct. And the thing that's unique about this cycle that we think can elongate the cycle is the Fed has said it's very cognizant of not raising rates to the point where it believes that growth will be threatened.
So a rate hike does not have to cut the legs off the recovery.
No, and
the bull run, in fact.
And in fact, our work further shows that once you get the first Fed rate hike, you rally for subsequently 2 years and on average go 33% higher.
Really?
So, yes.
There was some research put out this morning that says in the quarter after the last 12 tightening cycles began, price-to-earnings ratios actually contracted by an average of 7.2%. That would suggest that equities cannot withstand higher rates.
In the very near term. And we would expect perhaps a similar reaction, simply because it's very typical of volatility to increase in and around the time that the Fed does get active. And in a lot of ways, this year has been a bit of a treat for investors, not having been as volatile as one might normally have expected. So we would expect a little bit of a pause and some hesitation when it happens in September.
Julian, I like these combinations. Explain what's going on between the strength of the U.S. dollar and energy prices and why investors need to pay attention.
Sure. Well, again, the U.S. dollar has been one of the things that the Fed's really focused on in terms of showing restraint. It really doesn't want the type of appreciation that we've seen over the last 9 months to continue, simply because it's affecting earnings negatively. Again, the energy price decline has done the same, perhaps even to a greater extent than we would have figured, because the consumer hasn't spent to offset the gasoline price reductions. We do expect that as the year goes on, that the consumer will begin to get a bit more confident and spend a bit more, but it's definitely a concern that we're going to have in mind.
What other sectors do you like in this environment of raising rates?
Well, so if you look at the last 6 years or so, the one area that's been punished, the one asset class that's been punished has been cash. You have no return on cash. We're now anticipating that there's about to be a return on cash. So what we like are the companies that are throwing off lots and lots of cash, and you see that in healthcare, technology. Financials tend to do well in rising rate environments as well. But these companies have better earnings profiles and can take their cash and use it for M&A and buybacks, which, as we all know, has been part of powering the bull market these last several years.
Some might say the key driver of the bull market past few years.
Given the fund flows, that's a point that can't be disputed, because flows are anemic in U.S. equities, and buybacks have supported prices.